Thanks for tuning into today's webinar, guys. We are going to be jumping into today's webinar. We are going to be focusing on a bit of an Australian budget briefing, a bit of a market update across the economy, across share markets, currency, property, as well as interest rates, and then also doing some end of financial year tips. This time we're using Zoom. Usually we use GoToWebinar, so we are using a new technology, Zoom webinars. So bear with us if we do have any technical issues. I'll try and get to it very quickly if there is any muck-ups. Most people, they're tuning in from the US and Asia today. I can see an odd client or two actually in Europe, so I'm not sure why you're still awake. Go to bed, but a bit of housekeeping as we move into the slides. You will see either down below on the bottom of your screen or on the right or up, there's a Q&A tab. So as we move through it, please do submit your questions, because at the end we are going to have a bit of a Q&A discussion. We did do a webinar last night and the Q&A section went for quite a long time. Both these recordings from today and last night will be going up on our YouTube channels and going out to all those who registered, as well as a copy of the slides as well. So just a bit of housekeeping there. Why don't we kick into it and move on to the next slide. Disclaimers. What would a webinar or a presentation be without some sort of legal disclaimer? So anything you hear or see today shouldn't be construed or taken as personal advice or personal recommendations. It's purely information or entertainment purposes only. If you do require advice, please seek out at the appropriate professional, whether it's a tax accountant like Ben, a mortgage broker like Jeremy, myself, a financial advisor. Seek out the appropriate advice from a registered individual. Who is the Atlas Wealth Group? Well, we're a leading provider of Australian expat, financial advice, tax, mortgage services. We're regulated by a lot of entities. We're regulated by ASIC, the ATO, the DFSA. DFSA stands for Dubai Financial Services Authority. We have clients in over 50 countries and they do keep moving around, so we've sort of lost count now, so we're just going to stick it to over 50. We manage our clients' assets to over 250 million internally. All of our specialists in-house are degree qualified with numerous postgraduate certifications. So anyone that you are talking to, they haven't been doing this for 6 months or have come from a different industry or anything like that. They are match fit to assist you going forward. A little bit about the Atlas Wealth Group. Well, we're broken down into 3 different firms. We've got Atlas Mortgages, which is headed up by the Managing Director, Jeremy Harper, who is one of our panelists today. We've then got Atlas Wealth Management there, which is actually 2 offices. We're in Dubai and also on the lovely, beautiful Gold Coast, which is where I am. And I'm the Managing Director for the APAC region, where Brett last night, he is the EMEA region. And then lastly, we have our Atlas Tax firm, which is headed up by our Managing Director, Ben Turner, who is also one of our panelists today and co-hosts. Today's agenda and what we're going to be running through, we're going to be touching on a few different things, but essentially a bit of a budget summary, a tax update, a bit of an economic update, currency market update, some equity and how share markets have tracked for the last year or two, property and interest, and then lastly, a bit of a Q&A at the end. So do submit your questions as we move through it. I know plenty of people are on today to discuss questions around maybe where we sit with tax residency. Are there any changes that are happening in the background surrounding tax, all those sort of things? So please feel free to submit your questions and we will get to them at the end. But let's jump into the budget. And it was a bit of a no start or a bit of a boring budget, to be honest. It was definitely positioned for the current government getting re-elected. So I guess a safe budget, you could call it. Uneventful. The focus was more on what wasn't and what was said, I guess you could say. Clearly aimed at securing re-election. The key message that was coming out from the budget was trying to be fiscally responsible, keeping, I guess, the best interests of the economy front of mind, and then also avoiding reckless spending. It's interesting, though, when we consider the budget, there was still spending. There was still things which are going to stimulate the economy and could cause inflationary pressures. A great saying is about politicians. How do you know they're lying? It's generally when they're talking, when their lips are moving, and that's actually what happened. We can see that they spent a lot of money in a very quick space of about 2 weeks. So we'll jump into those specific numbers very, very soon. But what were some of their headlines? Stage 3 tax cuts. A reminder that that was actually already proposed by the previous government. So that's nothing new, but they did adjust it just prior to it all going through. So they essentially cut it in half, the tax cuts. The $20,000 instant asset write-off doesn't really impact a lot of Australian expats overseas, mainly specific for businesses, but not a new announcement, just an extension of an existing provision for small businesses. Freezing on social security deeming rates. Extension of the current policy for another 12 months. Social Security, so it's mainly referring to anything that you might be receiving from Centrelink here in Australia and how the asset and income test is applied to your personal situation. So by having that freeze on Social Security deeming rates, it means you're actually getting a little bit more from Centrelink or out of the system in terms of Social Security. So they've extended that for another 12 months. And then probably one of the big ones that did come out was the limit of indexation on the HEX and HELP program. Definitely a new announcement. I'm going to talk about it very briefly, but Ben's also going to talk about it in a little while as we move through a bit of a tax update. If we head over to the next slide, talk about inflation. So did the budget have a inflationary pressure or increase inflationary pressures? It certainly did, just because there was spending. So if we consider the revised federal spending, the initial estimate was 710 billion about 7 or 8 months ago. The revised estimate is now 727 billion. So we've added an extra 17 billion there in a very quick, short period when they announced the budget and released it. The new policies, well, 12 billion of that was due to new policies announced through the budget, or close to the budget, I should say. They usually obviously feed out a few announcements before the budget is announced, just to give us some insights. The deficit in terms of estimates, well, the upcoming deficit, 28.3 billion for next year. Without the last minute changes, that actually would have only been 8.9 billion. So a huge increase there on the deficit. I suppose the economic effect, the additional spending, it's going to have obviously a stimulatory effect on the economy. Not a bad thing, but when you've got inflation being an issue and you've got that inflation line beginning to flatten rather than continue its downward trend, that is an issue. You know, the economy right now is slowing right down, and we do need the economy to cool. So we're in a better awkward stage at the moment where they really need to keep inflation, the economy on an even keel, but we need to slow down to get a hold of inflation before they can look at stimulating it aggressively through maybe monetary policy, such as cutting the cash rate. Another update that we received was key changes to superannuation. So from 1 July 2024, the following changes to super limits will apply. So they're increasing the concessional contribution cap. It'll increase from the current 27,500 to 30,000. So right now, if you are in Australia and you're an employee by an Australian employer, your super guarantee that you receive, or your super guarantee from your employer, that makes up part of the concessional contribution cap. Right now, that's at 11%, but next year, or as of July, it's increasing to 11.5%, and that is slowly tiering up to 12%, which is great. For Australian expats or expats on the call, when you might use a concessional contribution might be used as an offsetting exercise, I should say. So maybe trying to offset some rental income, possibly get income to reduce your tax. There are going to be criteria for that, whether you're eligible or not. So make sure you seek advice as to whether that's the right strategy for you. The other update that we got, which was great, but it's just still not enough, to be honest, non-concessional contributions, the after-tax contributions that we can make to super, that's increasing from 110,000 to 120,000, so not much there. I commonly use non-concessional contribution for my clients that are probably 5-7 years out from retirement, and we're looking to squirrel as much into super just before age 60 where we can access it, just because super is still one of the most concessionally taxed environments when it comes to retirement, and that's probably the most common there. It is increasing the bring forward rule from 330,000, 3 years worth of non-concessional contributions, to 360. So just that extra 10,000 per year. Changes to HECS and HELP. This was an exciting one for anyone that has a HECS debt. Last year, we saw a significant indexation rate, 7.1%, the highest it's ever been since they implemented the HECS and HELP program. Many expats definitely felt the impact due to the high cost, I guess a bit of a stealth tax, you could call it, for expats that are overseas. The new indexation rules, instead of using only CPI, the indexation will now use the lesser of CPI or the wage price index. Now in Australia, we haven't had real strong wage growth for, I would say, a very long time compared to, say, the US. So it would mean that if they're using the WPI figure, it's going to be a lot less. And we've seen that change that they've implemented through the budget, and Ben's going to talk about that in a little bit. When we think about HECS, we do have repayment obligations. Since 2017, expats have had to do a HECS lodgement, and I guess that's why I like to refer to it as a stealth tax, because if you're in somewhere which is tax-free or a tax-free zone or a low tax, you're getting an extra maybe 3 to 7% tax that you're having to pay all of a sudden. The government will refund excess amounts based on the indexation factor, and again, Ben is going to talk about that and jump into it right about now. So I'm now going to hand it over to Ben Turner. Over to you, Ben.
Thank you, James. I thought it'd be worthwhile just going through in a little bit more detail exactly how the HECS help changes are actually going to work in practice. Bear in mind that the actual legislation for this hasn't come out yet, so we are working with what we understand is the way things will operate, and I don't see why this will differ, but just bear in mind there may be some changes. So just to recap the changes that we're looking at, from those people who received the indexation on 1st of June 2023 of 7.1%, the rate is slated to change to 3.2%. And for those that had the indexation on 1st of June 2024, you'll see on your help account, if you were to dig in, and I'll show you what that looks like from what I can see on as a tax agent in a second, the 4.7 that's been applied will reduce down to 4%, which is the new rate. So just to summarize who it applies to, it's anybody who had a help debt either on 1st of June 2023 and 1st of June 2024. If you had a debt on those dates, you would have had this rate applied to it. It's going to then be adjusted to this rate on the right-hand side. So just to sort of understand how help is considered for tax for the purposes of looking at your accounts, when we go through your information on the ATO portal, this is what we see down at the bottom here. There is the income tax line item and a separate help line item with a balance in each if you have a debt in the help account. Once you've submitted your annual disclosure for your foreign income or just a normal tax return, whatever it may be, then any amount that is raised as a liability that you need to pay off that particular year moves from the debt account in the help account into the income tax account and becomes a general debt. So if you go to the next slide there, James, I'll show you what the help account looks like if you drill down into it. And on the left-hand side, this is what it looks like. You'll see the particular transactions within that. So working off of a scenario where someone had a $10,000 help debt on 1st of June 2023, they would have had a 7.1% indexation applied to them. And similarly, they'll have the increased balance applied at 4.7% on 1st of June 2024, and then that will increase the total help amount. Now, on the right-hand side, I've included the calculations on what the expected amounts will be once they implement these changes and the likely credit you're likely to get on a $10,000 sum. So On this scenario, we're talking about $500 in credits. So even if you've paid off your help debt after this has been levied, what will happen is the help debt will be credited. The help account will be credited for the amount that is on the right here, and any surplus there will just end up refunding to you. You may need to initiate it from the ATO end, but that happens automatically if it's held in their accounts for more than 30 days. I thought I'd include a link there to a help estimator that the government has released, which is a good way to put in your specific value that your help debt's at and work out exactly how much you're likely to benefit from that. So that's the link there, education.gov.au/help estimator. Moving on to the tax rates, and as James mentioned, the stage 3 tax cuts have come in, albeit in modified form from what was originally slated. One of the biggest changes is this 37% tax bracket was meant to be completely removed in the original first iteration of the stage 3 tax cuts, but it's now been retained, albeit they've raised the amount from 120 to 135,000 where that kicks in. You'll see the tax rate of the 19% rate has reduced to 16%, so that will apply to those that are residents. The 32.5% tax rate goes down to 30%, and that's where a non-resident, their tax rates start at this 32.5% historically rate. Now it'll be 30% from 1st of July 2024. So that's a welcome change for, I'm assuming, for everyone. It's also going to be an easier calculation for people to work out, because it's actually quite a big range that people will have from 0 to 135,000 non-residents on their ordinary income will be taxed at straight 30%. Can we move to the next one? So when you sell a property as a non-resident, then effectively, if your property is worth more than 750,000, so the sales price is more than 750,000, then the current legislation says that you have to have 12.5% of that sales proceeds withheld and put aside for you to go to their tax office to make sure that you do your tax and true that up through your tax return. The government announced late last year that they're going to update the rate to 15% from 12.5%, and also reduce the threshold from $750,000 down to zero for rental properties. So all rental properties that are owned by foreign residents will be subject to this foreign resident capital gains withholding amount, which is quite a significant thing you need to be aware of. It is important to understand that this is just a withholding. It is just sitting in the tax bucket in the ATO. It's ready for you to complete your return, put the actual tax values through, and any refund that's due will come back through that process, or any shortfall you'll need to still make up any extra amount. So that is important to understand, but most people don't like there to be sitting a major excess with the tax office if they don't need to. So there is a form you can complete and apply to the ATO to have your withholding amount vary downward. You would need to explain to them your tax position and why your actual capital gains amount is going to be less than what was 15% or 12.5%, depending on the date. And if that is applicable to you, the ATO will give you a new rate which you can apply and provide to your conveyancer. So that's definitely available. It is a process you need to go through, but it is often a lot better in getting your cash flow back. Bear in mind that this measure here, we're still waiting on legislation. I'm not expecting it to be controversial or stall through Parliament. We just haven't seen the legislation yet. So in the next 6 months, I've effectively got to bring this change in. So treat that with a little bit with a grain of salt, but my expectation is it should come in by then.
Yep. And now a drum roll for this one, Ben. I'm sure
Yeah.
a lot of A lot of people on the call tuning in today's webinar want to know what is going on with tax residency and our useless government. So Ben, over to you. What is going on?
I'd love to be able to tell you what's happening behind the scenes, but there's nothing official yet. So, obviously late last year we submitted, there was the submissions put out to get everyone's opinion on the Board of Taxation's original report and see what, practitioners thought of that. There's a lot of submissions put forward. We put forward our own, poked a lot of holes in these sort of scenarios and look, to summarize, I think you ended up with a system, if you adopted what was in the Board of Taxation report, with a position that's probably more difficult to work out and administer than the current arrangement. That's sort of saying something. So I think we're kind of back to the drawing board a fair bit. I think it's going to take a long time for them to get their head around it and come up with something different. Doesn't help that we're probably going to have an election somewhere in there. So as we kind of alluded to last night, it's a bit of a wait and see. We're probably looking 12 plus months. And then if there's a change of government, maybe even longer for them to get the feet under the table and see where their priorities sit. So at this stage, it's proceed as normal. When there are updates, we will let you know. Obviously, it's very much of interest to all of our clients.
No, that's right, Ben. And in terms of an election, I mean, they can call one, say, later this year, October, or before May
October, I
next year.
believe, yeah.
Yeah, so
Yeah.
I think Queensland's got an election, and with elections, I think they have to wait a certain period before they can call a federal one after that. So there's very likely going to be an election coming because there's such a soft budget, a safe budget to get re-elected. So we'll have to wait and see what that all looks like. But continue on, over to you.
Yeah, sure. So just a couple of end of financial year tax tips. So obviously with the tax rate changing from 1st of July, it means that any discretionary deductions that you've got some flexibility on timing, if you can bring them forward to 2024 as opposed to having them in the 2025 tax year, then there's going to typically be a tax benefit to doing that, albeit relatively small often, but that's something that you could consider if your situation is pretty well consistent across those 2 years. If your situation is quite different, then you need to look at it a bit more broadly, but that's one thing that you should be thinking about. Also, super contributions are a great way to adjust your taxable income as a non-resident. A lot of people still like to top up their super, so if they do have positively geared properties or capital gains that they want to reduce the tax that's going to be due, then super contribution needs to be made before 30 June in order to claim a deduction for that as a concessional contribution. Also, the ATO is announcing their key focus areas. The first one, not super relevant in claiming work-related expenses. So a lot of expats that we'll deal with won't have a lot of work-related expenses because their income typically will be exempt as non-resident. But one thing that is quite relevant is the rental property claim. So a lot of people are under the spotlight for that. The ATO is saying that we're going to look at that a little bit more carefully. One example of costs that I've seen expats try to claim is travel costs for when they come back to Australia, have a look at their rental property and all of a sudden claim their flights and accommodation. That's not something that can be deducted. That deduction was stopped back in 2017. So if your costs are large, the ATO are sending out notices to pretty much everyone who's got rental properties this year. So they are putting you on notice for that. They're the main ones I wanted to sort of talk about regarding this financial year, but interested in any of your questions at the end of the session.
Thanks for that, Ben. I'll now jump into a bit of an economic update, and I'll do my best not to bore everyone today on the call, because the economy is not exactly the most exciting topics, but mainly focusing on the Australian economy for today, GDP, those sort of things. Let's get stuck into it. So running through, where do we see the Australian economy going? Well, we actually saw the GDP figures come out yesterday, actually. They weren't looking the most rosy, not from the ABS. The Australian economy grew 0.1% for the March quarter, or 1.1% as of the end of March of 2024. So we know that the economy is softening. We know that it's slowing down. Again, we actually want it to soften. We want it to slow down. The reason for that, because of the inflation line, or I guess that inflation line is flattening. So we don't want inflation to keep sticky where it is right now, where it's sort of trending around that 4% mark. We want it to get down to that 2 to 3% band. So in order for that to happen, the economy needs to go through a bit of pain, unfortunately. And that's sort of what we're in right now. We're in the thick of it. The budget, it showed an expected surplus in the underlying cash balance for the 2024 year, 9.3 billion and 10.4 billion positive turnaround for the 2024 mid-year forecast. Key drivers, higher commodity prices and personal income tax receipts contributed heavily to this. And we're unlikely to see, I suppose, juicy surpluses for the foreseeable future, probably for the next couple of years at least. Economic growth, well, Australia's economy, it's definitely expected to remain weak for the next couple of years. We probably won't return to that average, that long-term average, which came up from the budget there, 2027, 2028, mainly due to, I suppose, flatline or falling household consumption. We've also seen falling dwelling investment as well. It's been a significant factor. When you talk to a lot of people back in Australia right now, we know that there's just a lot less spending. Punters are pulling their purse strings, not spending as much, and we even hear about companies sort of releasing new product lines to target people where it's a lot cheaper. So there are some cost-cutting measures coming in, and things are getting a little bit cheaper, but it's taking, I suppose, a bit of time to see that actually play out. But definitely a lot less spending going on back in Australia. Inflation, it's interesting leading up to the budget because you had the RBA's projections on inflation, but then you also had, I guess, the federal government's expectations and projections on inflation. So the budget outlined a pathway to return to the target inflation, 2 to 3% by mid-2025. That was different to what the RBA is projecting. So who's right? The RBA expects inflation gradually reaching 3% by mid-2025 and stabilizing in its range by 2026 at some point. Near-term inflation still remaining high due to service cost or high service costs and global economic conditions. I guess the implications of those divergent forecasts, we're going to see higher cash rate where it is right now for longer. So rather than seeing maybe a cash rate cut this year, which is, I would say, a 99% chance that won't happen, it's very likely we'll see it at some point next year, maybe towards the end of next year, to be honest. And that's to really stamp down inflation, pull a lot of extra cash from households. So their mortgage payments will be a lot more, but it means they've got a lot less to spend. If they've got plenty to spend, it's going to drive up inflation. We saw those rate cuts that are happening in July or coming to fruition. It's probably not enough to have an adverse impact on inflation. It's just giving us a little bit more, but not much. I don't even think it changes the way maybe a bank assesses your loans. I'll let Jeremy talk about that later. When we think about the current economic conditions, again, we're experiencing subdued growth. We're softening. 1.1% GDP growth is very small, and it's likely to stay like that for the next 1 to 2 years before we start to pick up a little bit. But we actually need it to be like that. That's not a surprise. We need it to soften just so we can get a grip on inflation. That is what's most important right now. Currency market, jumping into the Australian dollar, how are we performing against our peers? Well, when we think about the Australian dollar, the two main catalysts that drive our currency is interest rates and commodity prices. They are I suppose heavily the two main ones, because then there's a flow-on effect on exports and everything. When we look at how we're performing, we can see there's a pretty stable relationship on the left-hand side there with the yen and the Australian dollar, especially in recent times. Probably the US dollar, that's been the most volatile. Recent trends we can see there. We can see that the Australian dollar is depreciating a little bit there as we wind out 2024 or mid-2024. A lot of that can be driven by the cash rate gap between the RBA and the US Federal Reserve. The US Fed, or the US as a whole, they are 6 months ahead of us when it comes to that cash rate hiking cycle. So as we see the US cash rate wind back and have maybe a rate cut, maybe at the end of this year, we'll see the US dollar depreciate and naturally the Australian dollar appreciate a little. And would say that over the next 12 to 18 months, that's more than likely going to happen. And that's good. It's not good for, I'd say, all my clients that are in the US that love sending money home and they're getting a terrific FX rate when they're sending it back, getting a lot more value out of their money. But that's going to unwind a little bit, we would say, the next 12 to 18 months. And a little bit of depreciation there, but relatively stable against the yen and the euro. The Australian cash rate, well, when we look at the key cash rate right now and where we sit, the RBA, it's obviously still hell bent on getting that inflation down to that target rate of 2 to 3%. And I guess an additional rate hike isn't off the cards. We'll talk about that actually on the next slide, but inflation's still too high. With where the cash rate is right now and where it's been, especially the real cash rate, we can see there that we've been in a period of, I guess, negative cash rate where any money that you had in your savings accounts was going backwards because the interest that you were generating on it was less than inflation. So that's essentially negative interest rates. That's the term that was thrown around a lot, 2022, 2023. Because the money that you had in your bank was just gradually losing value because of indexation. When we think about, I suppose, interest rate forecasts, where the RBA thinks we're heading, saying that by mid 2025 and then falls to 3.8% by mid 2026. So no rate cuts expected this year, maybe one next year, and then a gradual decline. The RBA have hiked every quarter where the trimmed mean has printed above 0.9%. So the March quarter printed above this at 1% and held whenever it is printed at or below this level. So if you want to make a bet on where the cash rate might go, keep an eye on the Q2 inflation print, 31st of July. If it's above 0.9 or 1 or 1.1%, it's more than likely a strong chance we might get another increase, 0.25% maybe. When we look at what the RBA's price, I guess the market is pricing, a really good tracker for this, and Jeremy and I love referring to this on our podcast, but the RBA rate tracker, it essentially takes the sentiment of the market and prices obviously where it thinks the cash rate is going. So we can see there, mid-2025, still above 4%, probably about 4.15%. So not dropping down to 3.8, but it goes to show that the market's starting to price that we might see a rate cut towards the end of this year, which right now, the way the economy is tracking, I would say is unlikely. So even the market is probably pricing it wrong, to be honest, based on how our economy is tracking and where inflation is at. We'd have to see inflation, I would say, the next couple of quarters, June quarter, September quarter, really show a key theme of it coming back rather than flattening. That's probably one of the main concerns. It's flattening right now. If we think about commodities, well, recent trends, they indicate a slight decline after reaching a peak, suggesting plenty of volatility in the market. We've seen some of our key commodities reducing as well. A big factor there is the demand from China or lack thereof and their construction sector with high inventory levels. Coal exports are increasing due to new mines, but prices are expected to fall due to weaker demand and stable supply. Naturally, Australia, we prefer periods of high commodity prices and high demand because that's great for our economy. It's great for the Australian dollar as well. That's usually when you see things, or the Australian dollar trading at quite high levels, 75, 76 cents. Haven't seen that for a while now. Not sure if we will for the next couple of years. It really just depends on a big change taking place. Global coking coal prices have recently collapsed on supply recovery and demand weakness, with the Australian prime hard coking coal benchmark falling by US 100 a tonne so far this year, reaching to the lowest level since July 2023. We really need China, especially on that next point there, we really need China to really try and fire up its economy, throw in stimulus to really get it firing up because that helps our economy. They are still targeting a 5% GDP growth this year, which is huge. However, we would want to see more stimulus being given to that market to make it possible. Let's move into and switch gears into share markets as a bit of an update. And share markets, they've been rather surprising, to be honest. I think we have to take stock of how awful 2022 was. The US share market finished down more than 20%. The Australian share market in 2022 finished down more than, I think, 6%, similar to the FTSE 100. FTSE 100 actually through 2022 was still resilient and still finished down, but not as high. And then we look at the last 12 months, we can see there, S&P 500 up 27.22%, ASX up 7.62%, FTSE 8.69%. So remarkably resilient. I guess whenever we're investing, we try and emphasize the importance of diversification. And there's always going to be some really important reasons for that. Different share markets perform, I suppose, different ways. They're not all positively correlated at all. It's the same with currencies and specific sectors as well. A really good example of that would be just 5 days after a recent peak made by the S&P 500. The S&P 500 then dropped about 7% in a matter of 5 days. 5 days, 7%. In contrast, the ASX 200, the FTSE, they didn't fall as far. They still pulled back, but not as far, 2 to 3%. So that's the power and the importance of diversification rather than solely being in one single index. And by being in more than one market, you're also getting exposure to different currencies. Currencies are really important as part of any investment strategy because they can act as a really good shock absorber, whether it be gains or losses. A really good example of that is actually COVID-19. COVID-19, when it all started to happen, we saw the US dollar or the Australian dollar get down to about 58 cents. So the US dollar was remarkably strong. Everyone flooded into the major trade currencies as a safe haven. And anyone that had, I guess, direct or indirect exposure to their US dollar through their portfolio, that acted as a really good shock absorber as well, compared to just a single index, I think dropping more than, say, 40%. So that's why it's important to always diversify, regardless of how share markets have actually performed and been really resilient. They've had plenty to deal with in terms of uncertainty. You've still got Russia and Ukraine going in the background. You've still got inflation. You've still got the quickest and, I guess, interest rate hiking cycle in, I suppose, modern history. You've also now, in the last 8-9 months, had this conflict going on in the Middle East, Israel and Palestine, and having an impact on oil prices and causing more inflation. Petrol prices, you go and fill up at the Bowser now, and you're waiting for the next cycle sometimes. So generally, it's been very volatile, still plenty of uncertainty, but overall, companies have still been meeting market expectations. We're still seeing positive results out of earnings, and I guess earnings season, which is really, really good. CEOs, they're giving, I guess, cautious guidance, which is good. So they're recognizing the importance of investors' expectations and not overestimating and taking more of a conservative approach, which has been good because it's contributing to stability within share markets. And we've got to remember, share markets, they are this perfect pricing mechanism. You know, they're forward-looking, 12 to 24 months. So they are a good read on the temperature of how everything is tracking. One particular point, especially when we think about indexes, the S&P 500 dominated by technology stocks, 60%. Companies like your NVIDIAs, your Qualcomms, they've significantly influenced the market and driving up overall performance. When you've got an index dominated by tech, it really drags up a lot of that index. So they've remained really resilient, but the earnings results have been meeting expectations, if not beating. So we're remarkably still in a pretty stable environment. And especially tech, there's been some key themes in tech. We've seen the rise of AI. And when we think about how should one construct their portfolio, well, diversifying is key. You know, having a combination of regional, currency, and sector plays. Sectors that often perform well, especially due to higher interest rates and difficult economic times. Financials, they generally benefit. There's definitely a caveat there. I'll talk about that soon. Energy stocks, they always perform quite well through these periods. Typically stable and resilient healthcare. It's just one of those defensive themes. We all need healthcare. Same with utilities, reliable performance, because we all need those kind of services. It's what we call a defensive theme through economic times. Sectors which are always remaining vulnerable through these times as well, high interest rate periods. Technology, it's definitely a sensitive stock. It's performed really, really well. It's been one of the best performing sectors, I would say, in the last couple of years. But it's not all tech. It's not across the board. The Australian stock market and our market cap and index, we've actually got a very small slice of technology. It's under 10% that makes up our market cap. When it gets big enough, it heads over to the US and we lose that. So, but there's been a big focus there on AI. A lot of AI specific type companies or companies investing a significant amount of capital in AI have done really, really well. We've seen that. Consumer discretionary, well, spending has been subdued due to economic times. And then construction and real estate. Here in Australia, still facing challenges. We're still seeing record insolvencies being published in Australia with some of the big guys. And you always hear of rumours of the big guys going under as well, doing around the traps. Winners and losers. This is a great little graph here, and I'll just explain it. It's not from us, it's from Charles Schwab, Ned Davis research over in the US. Great tool just to explain things. So it's a measure of the S&P 500 index sector median performance relative to the first rate hike recent by the US Fed, but also in comparison to the last 5 rate hikes going back to the 1994s. We can see there energy, a clear winner, having its best run. And if you look at energy stocks right now over the last couple of years, they've done pretty well. Next one, financials, we can see there, healthcare as well, technologies in there, communications, and also utilities. When we think about the numbers and if we deep dive into Australian banks, they're not as profitable. And the reason for that is that net interest margin. Jeremy's talked about it before in our other webinars and our podcasts where this big lending facility that a lot of the banks got through COVID-19, where it was pretty much at 0%, to be honest. They were given a free loan from the RBA, and then they could go and put out these fixed rate mortgages or variable mortgages, and they were making a very handy profit. But right now, the margins are razor thin, 1.9%. Very hard to run a business when your margin is 1.9%. I wouldn't want to be in that industry. So right now, I wouldn't expect sort of record profits being put out by banks in the coming sort of 12 to 24 months, maybe in 36 months when interest rates start to change. But yes, they are running a razor thin margin there right now. That's all from me. I'm going to now hand it over to Jeremy, who's going to jump into a bit of a property and interest rate update. Over to you, Jeremy.
Thanks, James. Thanks, Ben, and thanks, everyone. Good morning. So appreciate your time. So I'll just give you a little bit of an update what I'm seeing on the ground, particularly in the mortgage space, because it's ever changing. So some of the key themes coming out of the budget, if we just go over the page, some of the key themes that we saw coming out of the budget was a big focus on cutting the migration numbers from sort of 528,000 with a forecast of 260,000, and that's obviously a key topic heading into the next election, and that's one of the drivers and the demand in the real estate market in Australia. Obviously, the rental market's incredibly tight, which ties into the government also looking to introduce caps on international students, and that's really to try and take some of the heat out of the rental market that you're seeing. Some of those areas around the university where students are competing with non-students in the rental market, which is causing incredibly tight rental demand, and that's one of the drivers around the rental costs for people around those areas. I do think that international students are used as a bit of a fall for what's happening here. I think the underlying issue is really around the supply, which we'll get to a little bit later, and what that's doing to really cause the distortion around the demand in the market. So looking at some of what we're seeing around the existing mortgage market around some of the arrears. So we are seeing an increase in the 90-day plus. So there are some households there in Australia that are struggling to keep up with their mortgage with the higher interest rates and the higher mortgage repayments. And as we starting to see that, as James talked about, rate cuts may be looking longer or further down the line. So that's going to impact households a little bit more in terms of holding on to that higher mortgage repayment over that longer term. And we'll see that in terms of some of the listings on the property side, as you're starting to see some investors starting to put their listings onto the market, as they're starting to realize that, okay, well, this mortgage is going to be at a higher rate for longer. Instead of holding on to see what happens in terms of rates, maybe we list that to get rid of that or get that off our portfolio. So if we go across the page, so where are we looking in terms of capital? It's at the moment, it's incredibly hard to qualify for a new loan, and that's by virtue of just the way credit assessment is done. So it's essentially looking at your current rate that you're applying for. So at the moment, rates are sort of 6.5%. And then banks will apply a 3% buffer on top of that. So to qualify for a new mortgage, if let's say you're trying to buy a new property to occupy as an investor, you have to qualify at sort of 9.5%. So what that means is the ability to access credit has become incredibly hard over the most recent years. And what we can see here is when the rate hiking cycle started on the back of COVID, we saw residential lending, the demand really drop off. So it peaked around 34 billion a month in January 22 during COVID when rates went down. And then during the peak of the rate tightening cycle, the demand dropped down to about 23 billion per month. But interestingly, in the most recent 12 months, we've actually started to see the demand come back. So year on year, we're looking at about 18% growth. So we're back to about 27 billion per month. And that's actually driven by investors. So there's been investor growth of about 31% over the last year. And I think that's now, as investors or even owner occupiers looking at where rates are sitting, hasn't really moved a lot in the last 12 months. And so people are now starting to kind of look at where things are at and saying, are we at the peak or near the peak in terms of where rates are at? And then looking at in terms of the rental market and some of these markets around the capital growth, is this a time to get back into the market? So the demand is still there for credit. And if you look at where business lending is at the moment, obviously there's a huge demand there coming into COVID with businesses needing that support with that shutdown, and that's now started to really come back down. And as James talked about earlier around insolvencies with some businesses, they're starting to struggle under that higher cost of borrowing with that debt that they came out of COVID with. So across the page, if we look at this looking more around the building approvals. So from my point of view, with my customers that are looking to sort of build a single or maybe a larger development project or even do a renovation, it's still incredibly difficult. So James talked about earlier about how the builders at the moment, they're having all sorts of issues. Some are going under, particularly the volume builders where they sell on volume, so their margins are a lot lower. Some of the custom builders that I'm dealing with, where they can pass on those higher costs to the borrower and they can actually afford that, they seem to be doing fine. But overall, it's still incredibly hard to get a project started and completed. And I think some of the issues that the government are creating through higher red tape, higher costs, until that's fundamentally fixed, which all these changes that have been announced, I can't see any of that flowing through the market yet. We're still going to have this same issue around getting new starts, new developments off the ground and completed. And if you look at the graph on the left, the building approvals, if you speak to some of the larger developers, they are getting the projects approved, but they're actually holding on to some of these projects because from a feasibility point of view, with the higher rates and taxes, the margin's just not there to complete the project. So when we go back to around that supply demand conversation, and the government's looking at trying to pare back some of this demand through immigration, and they've also come out with this housing accord saying we're going to build 1.2 million houses over the next 5 years. We've even had industry experts come out pretty much straight away saying we're not going to get to that number. And I think if you speak to any builders or anyone that's actually going through this process currently, it's drawn out. It takes a long time. The feedback I get from people all the time is, this has taken, just to get the project started, it's probably taken 6-12 months longer than I thought. So I don't see a material change around on the supply side in the short term. So where does property, or where we see in terms of home values? So if you look at some of the metro markets, you can see here on a year-to-year basis, some of the smaller markets, Brisbane still powering along. You're seeing a lot of investors from, particularly the Melbourne market and Sydney, from the Sydney market taking some of their money and investing into Brisbane. And Melbourne, you're seeing a lot of investors fleeing Melbourne at the moment and taking that money into Brisbane as well. So you're seeing that consistent 15% growth in Brisbane, and even Adelaide still catching up in terms of some of the smaller markets around. It seems to be competing in line with Melbourne, but it's having great growth over that 12-month basis. And Perth is still catch up. Now Perth's a bit of a different market, being that sort of that one industry town. So that will be interesting to see how that performs over the next 12, 24 months. If we see a continual slowdown in commodity prices and what that does to some of those mining companies, and then what does that do to the real estate markets. But if you look at the Melbourne market, that's sort of come as a standstill, and that's, I think, in part a reflection around some of those aggressive tax and residency changes or tenancy changes in Melbourne. So if you think about the land tax, there's some significant changes there, which has impacted. If anyone on the call does have an existing property in Melbourne, I'm sure if they don't know about it, they'll soon find out around the land tax thresholds, the vacancy rates, even some of the rules around if you've got a tenant in your property, what you can and cannot do as a landlord. So what you're seeing is a lot of people that have a portfolio in Melbourne are starting to sort of review that position. And so if you go across the page and you look at the listings over the last 12 months, in Melbourne, the listing is at 25% higher than on the 5-year average. So if you look on the right-hand side, you can see there that went to auction. This is in May, over 1,000 dwellings went to auction in Melbourne alone, and the clearance rate's still holding quite strong. So you're seeing a little bit of a meeting of the market between the vendors and the buyers in Melbourne. And I can see that that's going to continue on as people are starting to reevaluate around that mix of investor properties within that Melbourne. So I guess that's probably a little bit of a caution to some of the other states that are continuously looking at changing their land and their stamp duty rules. New South Wales, they did bring in the ability to for a short period there around going away from stamp duty into more of a property tax. Queensland tried to bring in some alterations around their land tax that was wound back. And that's going to be a challenge for the state governments, where they do have a hole in their budget, but also they're quite reliant on property taxes as a source of revenue. Quite often, a lot of those states, 50-60% of their revenue is coming from those sources of income. So we just have to be mindful around that balance between investors and what the state's trying to pass through. So across the page, obviously we talked earlier around the changes to the tax cut. So Ben gave us an update. In terms of what does that do to our borrowing capacity, look, not a lot, roughly 5%. And if you overlay that on top of the changes to your borrowing capacity as a whole, regardless if you're an expat or in Australia, over the last couple of years, not necessarily just on the interest rates, but the baseline living expenses, I would say that all this is doing is clawing back a tiny bit of borrowing capacity that everyone's lost because of the higher minimum living expenses that the banks are applying on your application. So for example, a single applicant maybe 2 years ago might have been $2,000 a month as your baseline living expenses. That's probably now close to $3,000 per month. So the way the banks will look at that is to say, even if you're spending $1,000 a month as your day-to-day living expenses because you're quite frugal, the banks will still apply that higher of the two. And so quite often when I'm looking at the numbers, borrowers are losing quite a bit of borrowing capacity around those changes. So this is just making a small addition back. If the original stage 3 tax cuts went through, then that would have made a bigger difference on that higher income, but obviously that was repelled. So across the page again, just going back to on a lending side around the HEX. So Ben talked about how the change around the the expense or the inflation was going to be applied to someone's HEX balance. Does that really change on a borrowing capacity? No, not really, because the way it looks, the way the lenders will look at it, it's more on the repayment rate. So if you look at your income on the left-hand side here, this is the way the ATO is calculated per band. So if you sit in those bands, they calculate your repayment, which is a percentage of your income. So when I'm working with some clients that have a smaller HEX balance, something that may be something to think about is if you've got, let's say you've got $5,000 in HEX outstanding, but you've got a higher income because maybe you're a little bit more advanced in your career and you're trying to apply for a mortgage, the way it will work is it will be a percentage of a taxable income or repayment income, which is, you know, your wage income or your business income plus any investment income. So it might be rental income. So if you've got a small HEX outstanding, it might be worthwhile to pay that off and then take that difference or that increased borrowing capacity on the mortgage. So just be mindful if that's something you're looking at doing, it's an all or nothing. So if you've got $5,000 outstanding your HEX and you pay $4,000 off, that makes zero impact on your borrowing capacity. It has to be all or nothing. So that's just something to work through. But no, it does not really change your borrowing capacity, those changes that just came through. So across the page, so we talked about, you know, potentially higher rates for longer. You know, just this is a really interesting snapshot. So this is from a CBA financial report. I think it was a market update on the ASX from 2023. So CBA being the largest lender, and it gives us a good. This is quite old. This graph, but it gives us a bit of a breakdown of their book, of how many of their loans are still yet to mature off the fixed rate. So if you have a look there, there's still quite a substantial amount of loans that are going to mature up to that June 25 period. So that means that the CBA, and you know, if you extrapolate that against all lenders, they've got quite a few lenders that still not, the bulk has rolled off, but there's still a material amount of borrowers that are still on a 2.5% fixed loan that have not rolled out to 6.5%. So there's still that high interest rate still hasn't worked its way completely through the economy. So we've still got that to play out. So I guess when you look at what the RBA has done in terms of the tightening cycle, that still has a little bit of time to play out before we see the full impact. And across the page, if we look at the breakdown of, on the left-hand side, the variable, and the right-hand side, fixed rate. So obviously for our expats over in the US, at the moment, about 95% of all loans right now, or I think it's 98%, are variable. And you can see there, the new and existing loans, they work in unison with the RBA announcements. So the higher rates filter through straight away. And then on the right-hand side, you can see there, in the purple, the outstanding fixed loans, that rate has started to increase as people have started to roll off those loans. And then you can see there that the new fixed rates have just completely skyrocketed over those last couple of years. So going off that low 2% fixed rates during COVID, and now if you wanted to take on a new fixed loan, you'd be looking at sort of high 5-6%, which is basically in line with variable rates. So when we're having that conversation with customers, it's okay, well, there's not really a difference in pricing, but for people, it's more a case of, do you want to lock in this fixed rate now for maybe some budgeting certainty over the next 3 years? Obviously, people need to be mindful that if rates go down and they want to break that fixed loan in the future, that can be quite costly in terms of what that will cost the borrower in terms of a break fee. So that's all. Back to you, James. Thank you.
Beautiful. Thanks for that, Jeremy. That was great. We're now going to move through and jump into a bit of Q&A. And I can see a few questions which have been submitted. This is your time to turn up the heat against us. Try and get as much out of us as you can. So please submit those questions in the Q&A box, and we'll just read them out or address them. If there's anything which is a little bit too personal, I might just mention that, and then we'll try and sort of see what we can give you. Things to do for our, I suppose, expats with dialing today and tuning in. We do run a few different podcasts. We run Expat Chat. That's myself and Brett. We're on the usual podcast channels. We try and do an episode every week, and it's all about just giving our listeners and our expats more value coming from an education standpoint as well. So if you're wanting to arm yourself with a bit of information there of how to handle and tackle your finances, jump on Expat Chat. It's great. Another podcast we run is the Expat Mortgage one, which is Jeremy and I. And we run it on the same channels. We're talking about sort of personal finances, things that we're seeing in the mortgage market, what sort of interest rates are at, and any little updates to sort of policies, those sort of things. So jump on that one as well, because we do talk about certain things, strategies, extrapolate more value. Another important one is our Australian Expat Financial Forum. So that's a Facebook group. You are welcome to join it right now. We're tracking just over 3,000 members. And there's a lot of great stuff that goes on in there, a lot of discussion points, people throwing up questions or asking for help for certain topics when they're repatriating or first leaving, or when they're overseas, depending on the country they're in. Jump in there, throw up your questions. You'll have a lot of members join in the discussion and give you some feedback as well. Let's jump into a bit of Q&A now. A few questions have been submitted, so jump in there, drop your questions in, and we'll kick off with our first question here from Kashol. Ben, this is mainly for you around tax. So any change in the flat rate for non-residents, so the flat tax rate. So with those tax cuts, is there any change in the non-resident rates?
Yeah, so look, as it sort of mentioned, all the tax rates have changed. The non-residents aren't able to use the bottom two tax rates, but otherwise follow the resident rates. So the resident rates were changed, and so therefore the non-resident rates were changed. So the first dollar of income you earn as a full-year non-resident is taxed at 30% instead of 32.5%, and that goes all the way up to 135,000 for the year, and then it goes up to 37% and then 45%. So up to 135,000 a year. It's not a straight flat rate, as some people think, as non-residents, that it's straight 32.5%, which was becoming 30%. It does have a limit, and that limit is now moving to 135,000. So short answer is yes, it is, and it's going to be 30%.
Great question. Thanks for that, Kashol. Another question, which is it's almost how long's a piece of string, this one, Ben? This is you again. Our listeners are putting it to you. But let's read this one out. It's a bit long, so let's jump into it. We're close to retirement. We'll be returning home in 3 to 5 years. Our family, only one home has been rented since 2010. So family home's been rented and now considered an investment property. And if we sell, we'd have to pay the investment tax rate. Yep, makes sense. Could you please clarify what is needed to prove Australian residency when we move back home, and how long would we be able to, I suppose, live in it until we can sell it? We have to bother to be in the home, or can we sell it once we've returned and resumed Australian tax residency? It's a tough one, Ben, but there's a bit in that one.
Yeah, so the key thing here is the main residence exemption, right? So the main residence exemption requires that you are a resident at the time of sale to activate that. So you don't need to have lived in you don't need to move back into the property. You don't need to kick out tenants if you want to sell it without moving in and double move. You just need to be resident at the time of sale. So a lot of people will ask, well, what does that mean to be a resident? Can I sell on the day that I arrive in Australia? Then if all the factors are pointing towards residency, in the sense that you only need to satisfy one of the 4 residency tests, then you'll be a resident on the day. If someone was to jump into Australia and then jump out the next day, I would say that you wouldn't meet any of the residency tests, because predominantly the residency tests require that you are residing in Australia. You have an intention to make Australia your home, and you don't have a home somewhere else. So there's a few different facets to that. If you've given up your foreign home, you've moved everything to Australia, you intend to make Australia your home, my view is as soon as you land in Australia, you're likely to be an Australian tax resident. Obviously, seek our guidance if you're looking for more advice specifically on your situation, because everyone's situation is a bit different. But that would normally be when I'd expect you'd start your residency on the day you arrive in Australia without an intention to go and live somewhere else. And that would mean that you could sell it the day on that day or the day after signing the contract is the critical date you need to be aware of, and activate as much of the main residence exemption that it's available to you. Now, in your circumstance, if you've lived in the home, then the time you lived in it would be exempt as a percentage, a fractional percentage, also another 6 years potentially as well. So you'd tack that on to the end of it if it was rented out continuously and that wasn't refreshed. But again, we have to get into the detail. So there could be quite a sizable, quite a sizable portion of that that's exempt from Australian tax. It does consider a lot of other things. If you've got a main residence somewhere else in the world, or then you can only have one simultaneously throughout the world. So we need to consider all factors, but that's roughly how it would work.
Yep, no, that's great. As we can see, a lot in that one. I think when they changed the main residence exemption for expats, June 2020, that was a common one that we were seeing, Ben, with clients seeing if they could return home very quickly for a short period and then head off again. And I think the Commissioner of Taxation would look right through those ones if you're just trying to, obviously cash in on the main residence exemption. One here for you, Jeremy. Have there been any recent changes, like very recent, on policy updates or lending environment specifically targeted at Australian expats?
Yeah, good question. So yes, positive and negative. So yes, I had some banks come in and change their policy around expats. I think there's starting to be a bit more acceptance from the internal credit teams that the expat market is a good market to be in. So yes, so we've had some banks increasing their LVRs. So you can go up to an 80% for a purchase or refinance. We've got some lenders that will actually go into LMI if you need to as an expat. So that means you can go up to sort of 90%. Obviously, there's an LMI premium that you have to pay, maybe even a little bit higher. And that might be something that's suitable for a younger expat that just wants to get into a property and they've got a small deposit. And then a couple of other lenders are posturing around changing their policy in a positive way. And I think some of the changes I'm seeing is they've been a bit more open to accepting things like your type of income. So, like if you think about a credit assessment in Australia, like allowances in Australia, it's typically not a big component of your salary. It's normally just a base, maybe a bonus, maybe a commission. Whereas for expats, for some expats, that's a huge component of their package. It might be 50%, maybe higher. I'm seeing lenders are starting to be a bit more open to using or understanding that that's okay to be part of their package and using the allowance income and not sort of discounting how much of that allowance they'll use in terms of your borrowing capacity. So yes, there's been some positive changes.
Yep, great. That's really good. And you talked about currency there, and this is mainly a follow-up question that was submitted. Currency, I mean, are there some currencies which are better than others, the way that the banks treat it? Is there like the platinum currencies, then are there sort of silver, bronze currencies, the way they assess an expat's application?
Yeah, so the major currencies, if there's a lender that will accept foreign income, they will have, the major currencies, so USD, Euro, those type of currencies, they will be accepted. For some of the smaller currencies, then I guess it's a case of working out with individual banks. Is that within their credit policy? If it is, great. If it's not, maybe they need to look at an exception, or for some lenders, if it's not on, they may just have a list of currencies that they accept. If it's not on there, they just a non-starter with that particular bank. And then for some banks, yes, you're right, they may shade it back an extra 10% if it's not deemed sort of a major currency in their eyes.
Yep. No, understood. Good question. Good follow-up question. Question for me, which is probably a two-parter for Ben as well, to be honest. We're coming back shortly. You talked about contribution caps to super. Can we withdraw our Hong Kong Provident Fund and just roll it straight into super? Is there any tax implications for that? I'll go first, Ben, and then you can probably see if there's anything I'm missing from the tax side. There's not really any scheme where you can transfer a provident fund or central provident fund or mandatory provident fund, MPF, from say Hong Kong, Singapore, throughout Southeast Asia directly into an Australian super fund. They're very different vehicles. So an Australian super, like CBUS, Hester, whatever it might be, they won't accept just a random contribution from a foreign pension overseas, just because the tax treatment is very different, the way they actually assessed. I'll let Ben discuss, I suppose, how it would be taxed, but generally speaking, you know, after you know how it's treated from a tax aspect, you can use the contribution caps to put money into super, but it's really important you actually have an understanding of how it's going to be taxed. And that's going to require some tax planning and maybe possibly tax minimization strategies, because probably the only pension that exists right now where you can connect them is the UK pension scheme, where you might set up a self-managed super fund. You might get it registered on the UK's HMRC QROPS list. And as long as you've got someone on the other side, such as a UK financial planning firm, helping the Australian financial planning firm, you can actually do contributions into an Australian super fund that way. But outside of that, there's not too many foreign pensions where you can roll straight into super, because they're very different from a tax aspect. I know I get a lot of questions from my US-based clients around that. But generally, yeah, I'll hand over to Ben to talk about, how a foreign pension withdrawal might be treated.
Yeah, most of the times they won't satisfy the test for foreign superannuation fund, which will give you the ability to roll it across. So they will typically be considered foreign trusts, where the funds are being held on your behalf by a particular body, and then the drawdown of that fund is considered a taxing event. So the taxing event is typically that the tax is on the taxable on the actual component that you draw down, and so the whole distribution amount is taxable to you, but that can be reduced by any amount that you can evidence as part of the corpus, so the amount that you contributed to that fund. So it is quite important though that you can evidence the contributions. If the tax office ever asked, that you could track those and say, this is the amount I contributed, this is the growth in that fund, you should only be taxing me on the growth effectively from that distribution. So you do want to make sure you've got your ducks in a row, and if you don't have contribution history and it's been around for some time, then there may be some merit into relocating that the fund and rolling it into a new fund, and then perhaps resetting the corpus of that in the tax year prior to you coming back.
That's and that's a really good nugget for our listeners. If you've just heard what Ben just said, that's amazing. You are shedding so much tax from how the ATO might treat that in the future. So if you are going to listen to the recording, that exactly what Ben just said, that's really important. I know we talk about with our clients when they're rolling or pulling things out from their foreign pensions, but that's a significant opportunity. That 2 or 3 sentences, that will save you thousands in tax with the ATO long term. So bear that in mind. I've got another question here that's referencing when we talked about offsetting rental income or capital gains. If you've got a big capital gain, I heard there's a big contribution you can make into super before the end of this year as a once-off. So, I can answer this mostly referring to what's called the catch-up concessional contribution. It actually allows you to pull 5 years worth of unused concessional contributions from previous 5 years. And in the current year we're in right now, you can actually contribute up to $157,500, claiming that as a tax deduction. And that can be used to offset the capital gain that you might have made on, say, a property. That's a terrific opportunity, because it means that portion that you're putting into super, $157,500 that you're putting into super, you're ensuring that amount's only ever taxed at 15%, which is huge compared to, say, your marginal tax rates or your non-resident tax rates. So a significant opportunity. After this financial year, we will lose 1 year's worth. So it's still a rolling 5-year period, so that's really important. But right now, $157,500, it does assume that you haven't had any employer contributions going in the last 5 years, or you haven't made your own pre-tax or concessional contributions as well. So there are some criteria on that. So don't go ahead and just do it. Seek out for advice to make sure that's the right strategy, because if you're not getting the right advice there or doing the right thing, you actually could, I guess, not necessarily be better off. You could be penalised by, say, the ATO for some reason. So a good question there, that's for sure. Jeremy, one for you around refinancing. Do you find it's easier to refinance on a mortgage for a main residence, or easier to refinance on an investment property for just a normal Australian resident? Are the banks being favourable there, given that you already have a loan and you can show that you can service it?
Yeah, good question. So, I mean, if you can service it, then obviously you've got good credit history. If you've had the property for a couple of years, there's probably good equity within there. So that's one hurdle for expats. If you've got 20, 30% equity in the property, then that's great. Then it will just come down to the serviceability. So, some of the challenges, particularly for expats, say in the US, you might be earning a higher income gross, but then what's your personal expenses? So, if you're in New York or LA, or California, what's your rent expense like? Have you taken out some car loans? They're the things that are going to impact your ability to refinance and actually qualify for a new loan. So just be mindful around that. And it might be a case of, like, so for example, if you're in the US and you've got a lot of credit cards open, of course that works against you in terms of the ability to take out an application in Australia. So let's say you've got $100,000 in credit card limits in Aussie values in the US, which actually isn't that uncommon. That's going to reduce your borrowing capacity by about $500,000. It's a factor of 5 to 1. So
Yep.
that's probably going to be your biggest consideration around can you refinance, going to come down to serviceability.
Yep, understood. We've got a few more questions that have filtered in where we are going to wind up very shortly, but I'll just answer this one from Andrew around, can I continue to make concessional contributions to super of 27,500 each year directly from Singapore using pre-tax Singapore dollars, or from an Australian bank account receiving pre-tax Singapore dollars and send back to Australia? Or Andrew, there's probably a few other questions I'd always want to ask. Are you a non-resident of Australia? Are you a tax resident of Australia? I mean, there's probably a big myth out there around superannuation, but you can contribute to super. When you're overseas, if you're an expat, you can contribute to super. Whether a concessional contribution is the right type of contribution, that's probably the question I have for you, because we wouldn't want to make a concessional contribution to super if you don't have any other income that you're trying to offset in Australia, because then you're just paying tax for no reason, and it would more than likely be an after-tax contribution. You won't get any benefit from the Singapore Internal Revenue Department as a tax deduction for making the contribution to super, if that's sort of the thought line that you're heading there as well. So there's probably a few more questions that we could answer around that one, to be honest. Another one here for you, Jeremy, around financing. If we are refinancing currently, but aware we may, or we are, or may be expatriating, what are the obligations to declare this? Oh, that's a good one, actually. Only if specifically asked, question mark. What if the refinancing process has just started, but it is continuing after we expatriated? So what's their obligations to tell the lender that they're heading overseas, Jeremy?
So when you do your applications, there's a question around, will there be any material changes to your financial circumstances in the next 12 months? So I guess that's really comes down to how you interpret that question. So material changes, if you apply for a new mortgage, but you know that in 2 months' time, neither applicant will be working, that's material. So you'd need to cross that off. Or if you're going to have a new child in a couple of months. If you're going to move to another country, but you're going to be on a higher income, I don't think that's a material change to your circumstance that's going to impact your mortgage. Or so that's how you declare that. But if you are going to move overseas and be on substantially less income than what the assessment on the current mortgage, then yes, I would answer that or declare that. In terms of the process, so once the loan's formally approved, obviously it sounds like they're making the assessment based on your current Australian income. The bank will then, they're within their right to ask for any information up until settlement. So just be mindful that if they may, within their right, ask for a payslip the day before the refinance is settled, and it's in a different income, then perhaps that lender won't accept foreign income, or maybe they're okay with that. So that's just something to be mindful of. I'm not seeing that. I'm not seeing banks asking for payslips for refinances a week before it's due to settle. Once they've made the assessment, it generally goes through, but that's a variable that could pop up. The bank can ask for anything up until the loan closes.
Yep. Yep, good question there, Andrew. That might do us for today. We really appreciate everyone tuning in for today, dialing in and listening to today's webinar. A bit of housekeeping once more. The recordings will be going out in the next couple of days. We'll also be sending out the slides. Follow us along Facebook, LinkedIn, Twitter. Well, not Twitter anymore, I guess we could say, as well as Instagram. We do our best to post on Instagram, but it's us doing our best, so you can imagine what's going on there. In the meantime, really appreciate everyone's time. Have a lovely evening, afternoon, or morning, and we'll see you guys on the next episode or webinar. Cheers. Thanks to all my co-panelists as well, Ben and Jeremy.